What's up guys, John here. What the local governments across the country are doing alongside Zillow and of course big insurance companies is going to reshape and change the landscape of being a homeowner all throughout the country.
The way we buy and sell homes is changing because of climate change.
Zillow recently announced it's adding climate risk data to its property listings. It's just the latest website to do so.
As the cost of living continues to explode and wages soften, Americans have very little option but to borrow.
Buy now, pay later loans have been in use for big ticket items for years. A growing number of American consumers are using the payment method for everyday items.
And that being said, homeowners sitting on a record level of accessible home equity. Withdrawals from home equity lines of credit during the first 3 months of 2025 reached the highest first quarter level in 17 years. So people are borrowing at levels that we haven't seen since the great financial crisis, and thinking that if they borrow this money, they'll be able to get out of the storm, not realizing that the storm is ahead of us and not behind us. In the very near future, the next year or so, we will see millions of people walking away from their properties as they realize the cost of owning this property and managing this property is far more expensive than simply renting. But there's a twist at how this is all likely going to work out. In this video, I'm going to break it down and show you what's going on, why I believe we're walking into a once-in-a-lifetime opportunity to build generational wealth. Please hit the like button. When you do, YouTube will share the content, educate people about what's unfolding in the housing market. Take a look at this. So about a year ago, Freddie Mac proposed a $850 billion origination volume, and they were going as high as $1 trillion, some estimates saying as high as $3 trillion. And what this is going to do is, they said it could face challenges due to lack of robust securitization market, according to strategist Bank of America, is they were going to start issuing loans to homeowners on the value of their properties. So if that did happen, which now it looks like it did, and it's going to likely grow in popularity, you have to ask yourself, who's going to be the winner of this? It's going to be the lender. It's always the lender. But when the lender is the government, and you start to kind of connect the dots here, you'll see how this whole thing is actually going to shake out. Government-backed mortgage securitizer Freddie Mac is considering whether to broaden out its portfolio from first-time mortgages to becoming a purchaser of home equity lines, a move that could offer borrowers more favorable terms than those in private credit markets. Now, they said that, and then Trump was elected. Trump said that he's working to take mortgage giants Fannie Mae and Freddie Mac public, winding down 17 years of federal control over two central parts of the U.S. housing market, a move that was cheered on by Trump ally and noted Wall Street investor Bill Ackman. Ending the conservatorship of Fannie and Freddie, which guarantees trillions of dollars worth of mortgages, would be complicated, and critics say it's risky. A plan to do so in Mr. Trump's first term did not come to pass, but the president announced last week that it was considering the move, pointing to the firm's return of profitability since the 2008 government takeover. So if that did happen, and they did go public with Fannie and Freddie, mortgage rates would increase.
President Trump reiterated Wednesday that his administration is working to take mortgage giants Fannie Mae and Freddie Mac public, but still keep them under U.S. government oversight.
Why? Well, Freddie Mac primarily makes money by charging guarantee fees and loan level price adjustments, LLPAs, on mortgage loans that it purchases and bundles into mortgage-backed securities. These fees are paid by investors who purchase the MBS, mortgage-backed securities, and they're effectively a price of Freddie Mac's guarantee that the underlying loans will make payments. So if the government is not going to support Freddie and Fannie, that means the investor is going to absorb more risk. Now, if the investor is going to absorb more risk, they're going to increase interest rates to account for that new risk. Now, if that's happening, and then at the same exact time, cost to borrow is getting more expensive across consumer loans, and defaults are skyrocketing, talking buy now, pay later, talking home equity lines of credit, the costs have exploded the last couple of years. Auto loans, everything has gotten more and more and more expensive. Who's going to win? It's going to be the lender, right? But you have 45% of first lien mortgages are government-sponsored, entity eligible, also known as conforming loans. These loans are bought and sold by government-sponsored enterprises. Now, here, look at just kind of how they're working in states like Florida, places like California. It's collusion at best, and it's something I'm not even going to say here at worst. Here, Citizens Property Insurance Corporation had about 800,000 policies in Florida, right? They were saying they're up at about 1.4 million policies in 2023. So if they're basically floating the insurance market in Florida, the government-sponsored entities, which is exactly what Citizens is. Citizens, the insurance corporation, government-backed, right? Well, they're involved in the loans, they're involved in the insurance, they're involved on the tax side. They're making money on every angle of this, and the American people are getting stripped of their life's work. Now, when you look at, for example, California, right? 3 weeks ago, California approved State Farm's 17% increase in home insurance premiums in wake of LA fires, right? 3 weeks ago. About 5 days after that, they increased another 11%. They say this is only a temporary increase, right? So that'll be a 28% increase. Then, 1 hour ago, State Farm again requests 30% rate increase for home insurance policies, more for condos. So the cost of everything is going to continue to get more and more and more expensive.
Homeowners insurance market is just crazy right now. The rates that we're seeing are double, sometimes triple of what you paid last year.
So the people that are taking out these home equity lines of credit thinking, hey, I need to stay in my home, I don't have an option. They don't realize that the taxes on that home, the insurance that they're going to be paying, these premiums, are only going one way, and that's up.
Insurance premiums have almost doubled.
I moved here from Colorado, and the insurance rates out here are significantly higher.
So unless wages are going to radically change across America, which I don't think is going to happen, people are going to be walking away from these homes at a pretty alarming rate. Now, what I find fascinating, though, is most people, they determine their net worth through looking at their home's value on Zillow, deducting the mortgage, and then adding in their other assets, saying, oh, this is what I'm worth roughly this. But when you look at the housing market right now, we're in prime selling season. There's 500,000 more sellers than home buyers. Homes are stalling on the market. They're not selling.
Home sellers now outnumber buyers by the biggest margin in 12 years.
People selling homes outnumbered buyers by nearly 500,000. This should make it a buyer's market, more homes for sale.
We've seen the number of sellers outpacing buyers by more than 33%. That's the largest gap since 2013, according to Redfin.
And so what is likely going to happen is we're going to start seeing people question their true net worth as they realize that Zillow is off. But when you look at how the local governments are taxing these properties, they're taxing them as if they're luxury mansions. Every single home. Remember 10, 15 years ago, thinking of $1 million home, you would think of some mega estate. Now $1 million home in most cities is some 3-bed, 1-bath shack or 3-bed, 2-bath shack that needs work, right? Overall increase from 2019 to 2024, property taxes nationwide increased by approximately 30%. This translates to a rise of around $539, reaching a median $28.26 in 2023. Reassessed properties for properties that underwent reassessment between 2019 and 2023, the median increase was around 26.3%, or about $612, reaching $29.43 in 2023. However, now the annual increase in 2024, the average property tax bill on single-family homes rose by 2.7% in 2024, reaching $41.72. $41.72. So you look at just how far we've come over just the last 5-6 years and where we're likely going to be going. Now, what I believe is very likely going to happen is food cost across the board. It doesn't matter if it's apparel, everything is just going to get more and more and more expensive. If this doesn't go back, like medical care, for example, if this doesn't go back, then we're going to likely see a situation where people are going to have no choice but to downsize, and they're going to downsize by renting. And they're not going to have to maintain, operate, they're going to have to pay for insurance or taxes. But how I think that this entire situation, I mean, even look up car insurance up 55% since 2020. How I think this entire situation is going to happen is I do not believe, I want to be very clear about this, that there's going to be some loud crash like 2008. I think it's going to be more of a quiet depression or silent depression, mainly felt by the bottom 90%. And as these loans go unpaid, these loans are going to get sold quietly, and they're likely going to get sold to private equity. Private equity will buy them in bulk, and then they're going to rent them back. That's what I think is very likely going to happen here. I don't think it's going to be some situation where we're going to see 100 homes for sale in one given neighborhood. I think the inventory is going to look tight, and it's going to quietly transfer hands, and then it's going to get listed for rent. But it's a shame when you look at just what's happened since the last 5 years. We've seen the cost of everything balloon, everything explode. The quality of living and the standard of living which people are in now is pretty concerning. But where it's going to be going in the next year or two is, I think, going to be worse. for most. However, if you are an investor, if you have cash, this is the reality we live in. You want to position yourself for it, because if you don't, a large corporation will. You want to have a great business or a great job. You want to be out of consumer debt. You want to put yourself in a position to buy one or two really, really great properties, knowing you can comfortably afford them, and that they would cash flow if you were to rent them out. I think a lot of people right now are kind of surprised that bought a year or two ago about how expensive it is to be a homeowner. Like they thought insurance and taxes were going to remain soft where they were, but every time they open up that envelope, prices are going up, up, up. I think investors that are buying multifamily, I think investors across the board in real estate right now are really taking a cautious outlook on where they're allocating capital. That's why I'm in Ohio. I'm buying these properties for 80 grand, 90 grand. If taxes doubled, which I don't see happening, insurance doubled, the deal still cash flows in a very large way. Most markets in the country, if insurance goes up 20%, 30%, taxes go up 10, 15%, it's a crisis, right? It's a real problem. Here, if mortgage rates go, let's say from 7% to 10%, I don't care. It doesn't matter, right? Everywhere else, it's the end of the world for people financially that are, in commercial debt, that they need to refinance at the wrong time. Here, it's a different game. So I think when we just look clearly at what's happening with HELOCs, the position that people are in right now, look at Klarna. They're suffering $99 million in losses. People can't afford to pay back their installment plans on burritos and pizza and groceries.
25% of Americans who have buy now, pay later loans are using them to help afford groceries. 41% of those customers admit to making a late payment on a loan in the past year.
We're walking into this massive shift of wealth. Put yourself in a position to capitalize on it and take advantage of this moment, or another company will seize the moment and you could be renting from them, tragically. But that's the future in which they predicted, that everyone's going to be renting everything. Put yourself in a position and absorb these costs that are going to be coming. Own the property outright, have heavy equity inside of these properties, have a fat cash position, and be able to pivot and navigate through the storm, because the storm looks like it's here. But I'm curious what you think about this entire situation. Let's have a conversation below. And if you'd like to learn more about what we're doing, you can click the link in the description. And if you have 100K in cash or more, and catch you next video.